Good morning, everyone. Welcome to this webinar where we are going to discuss about first half results, which were released to the stock exchange 2 days back. So as usual, I will take you through some presentation, and then after the presentation, we can entertain the questions. So we have the top team of NDB. Some of them you can see, others are with me. So if there's any question related to their specific areas, they should be able to provide clarification. So the next slide. All right, yes, right. Okay. Business overview. NDB is, I think, one of the unique banks here where we have, apart from the banking group, we have the investment banking arm, which and also the wealth management, the stockbroking arm, and also the fund management side. So all in all, as a group, and in, of course, the DHPL, which is a 58% subsidiary with balance with NDB. So all in all, the group, the major development during the first half was, I believe, the relocation of NDB Capital Holdings into a new location at Bauda Lokamawata. So where NDB Investment Bank, the wealth management, the stockbroking arms, everyone got relocated, and we got the central bank approval also to open our own branch there, so which should happen shortly. So this is actually a one-stop shop in terms of the investment banking, all the services provided under one roof. So that I would say as one of the key development that happened with regard to the NDB group. In terms of our presence, we have 106 branches now. Of course, during the first half, 2 branches were added onto our network, Kottawa and Katana, and 118 ATMs. The mobile app, I think one of the, that's a mobile app that's most awarded mobile app. I think that's the other way of reaching to the clients apart from the branches. And we just crossed 2 billion transactions in July for 6 months, transacted through the mobile app, and roughly about close to 200,000 transactions during the first 6 months. That shows that, okay, through digitally also we are trying to expand our reach, and this is one way that we reach our clients. So I think 2 billion within 6 months is substantial number of transactions. In terms of the social media presence, bank is quite active, and I think our website alone we have over 400,000 followers in terms of social media. So we will continue to I think capitalize on the one is the branch network and also the other digital channels to reach our clients and provide our services. So that's our plan. In terms of the recognitions that we received during the first half, I think we have been receiving quite a number of awards. I think the Asian Banking and Finance magazine, they have in their retail awards, we have been categorized as the best domestic retail bank for 2017. Actually, this is the 5th consecutive year that NDB has won that. And similarly for our SME, the best SME bank, and also the Mobile Banking Initiative of the Year. Those were recognized. The Asian Bank and Finance Magazine of Singapore, again, for wholesale banking, domestic project finance bank, that's for the third consecutive year we won. And also for cash management, the best domestic cash management bank of the year 2017. That's for the second consecutive year. So both the retail and corporate side, and including cash management, we have been internationally recognized. And in terms of local awards, SLT 01 award recently for the mobile app, and also LankaPay Technovision awards. Again, we were the runners-up, but I would say among the bankers, our mobile app was adjudged as the best mobile banking app. Women in Management Organization again has recognized bank's contribution in terms of our activities in developing women's credit skills and also their contribution to the society. And in addition to that, Global Banking and Finance recognized us this year with 3 awards, again for the best mobile banking application and as best SME bank, and also for our investor relationships, the best investor relationship bank. And I think I would say that, okay, these kind of discussions with the investors, with the analysts, we would continue to have these kind of forums, and that has been recognized through the best investor relationship bank. And then from the marketing side, CMO Gold and Global Brand Excellence Awards held in Kuala Lumpur. Bank was recognized with 2 awards. And we're talking about the NDB group. Global Brands Magazine again recognized us as most trusted investment banking brand for Sri Lanka. And Asia Money Banking Awards, Best Corporate and Investment Bank in Sri Lanka. And Euromoney recently, they have recognized both investment bank in Sri Lanka as well as our branch in Bangladesh as best investment bank in both these countries. So these are some of the awards I thought that we should share with all of you. And I mean, we continue to win these kind of recognition actually that motivates us and all our staff to deliver what we are doing best, which is providing financial services to our customers. Moving on to some quick economic update, what we believe from our analysts and from our treasury, the input that we have received. Naturally, the global economy is still slowing down. What we saw was around 3.5% growth in 2017, and global output predicted to be around 3.6% in 2018. And monetary policy normalization in some advanced economies, especially US, that can trigger some unanticipated tightening in the global financial condition. So apart from that, in the Sri Lankan economy, we saw growth rate coming down. First quarter 3.8%, naturally, and the second quarter would be much lower, naturally due to the flood effects and even on one side the drought effect that we are experiencing. So headline inflation and core inflation has gone up slightly to 6.1% and 5.1% respectively. And inflation is projected to be moderated to mid-single digits by in 2017 and stabilize thereafter. So we do take these assumptions in our decision making in terms of our pricing, especially for deposits, when you take on the longer term deposits. And the exchange wise, we have seen a gradual depreciation, roughly the Sri Lankan rupee from 149 to 154, about 2% depreciation in the first half. And market interest rate, we have seen a slight reduction in the interest rate in terms of the deposits, and we would expect that trend to continue for the probably the second half as well. Talking about the banking sector, the SDFR and SLFR remained at 7.25 and 8.75. And then year-on-year asset growth up to May, what we have seen is roughly about 14.9% growth in assets and 20% growth in deposits, the industry growth. You would see that our numbers are slightly above the industry average. And in terms of interest rate, the recent development, I would say, is the removal of the cap on the interest rates from 24%, and also the cap on the penal rate, which is for any overdue or unauthorized excesses, which was earlier capped at 2%, has been removed. So it's more risk-driven, market-driven kind of arrangement which has been put into practice from 1st of July. So that's something I would say a new development in the banking sector, which was the case many years back, which was later on capped. Moving on to the financial performance on the first half. In a summarized format, you would see the profitability of the bank, the net operating income that has grown by 32%. This is year-on-year comparison from first half 2016 versus first half 2017. So from 5.4 billion to 7.1 billion in terms of net operating income. Operating expenses, it has gone up only by 5%. We have been managing it quite well, from 3.1 billion to 3.3 billion. So as a result, the profit after tax figure has improved by 81%. This is at the group level, from 1.2 billion to 2.3 billion. So almost 1.1 billion in terms of quantum. There's an improvement in profit after tax year on year. In terms of the balance sheet, total assets, we had 9% growth. This is actually comparison from December 2016 to June 2017, 6 months, from 335 billion to 365 billion, about 30 billion increase in assets, 9%. Loans, that has substantial growth from 228 billion to 252 billion. That's 11%. That's 25 billion growth in loans. And in terms of deposits, it has grown by about 35 billion from 204 billion to 239 billion, a 17% growth. In terms of our efficiencies, cost-income ratio has improved from 49% previous year to 43.2%. That's one area that we were focusing. And then the other major improvement is on the NIM from 2.64 last year, December, to 2.74. So that's roughly about 10 basis point increase in NIM, which is an area that we are continuing to focus and trying to improve on. So you would see that figure is gradually improving. Return on equity, that has improved again by about more than 100 basis point, about 150 basis point, from 13.3 to 14.63. Still, we have to keep on improving. This is still below the industry average level, but that's one area that we are focusing, especially which is part of our strategic plan. And one key improvement is the NPL ratio from 2.6% December, it has improved to 2.22%. That's a substantial improvement in terms of the credit quality, which is below the industry average. In terms of business capacity, the loan to deposit ratio, again, quite a good improvement from 115% last year to now 108% as at June. So we will continue to work on this area. We are self-financing our own lending book. So it's at 108%. And then on the capital adequacy ratio-wise, we are maintaining 12.76% ratio, still well above the requirement in terms of both regulatory requirement and also our own internal capital assessment requirements. Liquidity ratio is maintained well above the minimum 20%. Right now it's 22.3%. Some detail about the income statement. Net out of this total income, the net interest income, we had first half 2016 versus first half 2017, 17% growth. In terms of quantum, 706 million growth from 4 billion to 4.7 billion. Other income again, or more than 700 million growth in other income, from 1.1 billion to 1.8 billion. So that's actually a 62% growth. So operating income has grown by from 6.2 billion to 7.7. Impairment charges compared to last year first half, which was 820 million. This time it is 581 million. About 200 million reduction in terms of impairment charges, mainly due to the portfolio quality improvements. And last year, of course, there was substantial specific impairment that we made as well on one particular account. That was last year. In terms of operating expenses, quite a good progress made in terms of it. The growth is only 5% from 3.1 billion to 3.3. We will discuss more about it in the next slide. And as a result, the operating profit level, 70% improvement from 2.2 billion to 3.8 billion. So that's about 1.5 billion increase in the operating profit level. Tax, there's a naturally 55% growth in tax with the improvement in the profit. Last year we paid roughly 1,965 million, and now it has gone up to 1.5 billion. So profit after tax, 81% growth, and profit attributable to the shareholders at a group level, 37% growth from 1 billion last year first half to 1.486 billion, about 400 million increase in PAT level. So PBT and PAT, you would see that the overall the profit, operating profit, there's a 70% growth. This is partly due to a dividend income received from the group companies. But even if you take out the dividend income, the growth in both PBT and profit after tax level year on year is 56% and 63% respectively. So which shows that even without the group dividend, the core banking side, a substantial improvement in terms of contribution to the profit after tax level. This is more detailed analysis about the revenue. There again, the interest income, you would see 36% growth in interest income. Quantum-wise, 4.7 billion growth in interest income. Partly due to the growth in advances, we had quite a substantial growth year on year in terms of substantial growth, plus the interest rate increase. Interest expenses, again, from 8.9 or 9 billion to 12.9, 13 billion. So again, 4 billion increase in interest expense. So as a result, the NIM, net interest income, grown by about 740 million from 4 billion to 4.7 billion. That's 17% growth in NII. And 44% increase in the interest expenses due to changing CASA composition of the bank's deposit portfolio, where the CASA ratio now remains around 22%. Now the NIM, you would note that there's about 10 basis point improvement to the NIM from 2.64 to 2.74. Mainly, one is volume growth, but the NIM has gone up due to repricing of our book and also a shift towards more retail and SME credit. And also we are also looking at overall return to the bank whenever we take a decision in terms of dispersing funds. So, I mean, those three measures have contributed in improving NIM, which we will continue to focus on. Net non-interest revenue side, we had 6% growth year on year from 1 billion to 1.141 billion. That is fee and commission income. Trading side, the 17% growth from 456 million to 533. And from financial investments, again, there's a slight drop from 128 million to 122 million. Other operating income, quite a substantial growth. That's from 556 million to 1.1 million. Yeah, so that's actually the group dividend that we have received compared to 556 million last year, 1.1 billion. So that's where the growth is. So total non-interest income, you'd see 35% growth from 2.2 billion to 2.9 billion. In terms of non-interest income growth, excluding the group dividends, is about 12%. And net fee and commission growth is about 6%. Now that's where we are working heavily on targeting this NII to net fee income ratio to grow to a mix like 70-30. So that's one area that we are working on, improving our fee-based income further. Operating expenses, this is where we see about only overall 5% growth. One is there's a personal expenses about 2% reduction. I would say that there are two major reasons that contributed to this drop, despite we increasing the staff overall benefits. One is the number of staff reduction from 2,100 to now it's about 2,070. It's about 40 in terms of number of staff reduction, plus some other movements of some of the senior management level turnover that happened during the latter part of last year. So all in all, the increase first half versus this first half is actually a 2% reduction. But going forward, I think with second half, we are looking at staff salary revisions and there's some market survey numbers we are expecting. So all in all, we would say that we would expect about some increase, about 5 to 7% increase when it comes to the year end. In terms of other expenses, there are 16% growth from 1.2 billion to 1.4, roughly 200 million increase. That's mainly due to the VAT increase from 11% to 15%. Plus, of course, our deposits have grown substantially, actually by 48 billion from June 2016 to June 2017, 48 billion growth in deposits. So naturally, there is deposit insurance cost as well, which we had to bear like all the other banks. So that is also part of the increase in the other expenses. Plus, of course, during this 1 year, four new branches were added onto the system. And then also we had 2 product launch during first half, which we will come to discuss more in detail later on. But all in all, with all that, we have managed to keep the cost increase to 5%. Talking about the balance sheet, overall 9% increase in balance sheet from 334 billion to 364. This is December versus June 2017. Mainly it's coming from the loans and advances. from 227 billion to 252 billion. That's 11% growth. In terms of liability side, the growth is coming from deposits from 203 to 239, so 36 billion growth in deposits. And we have been consciously concentrating on CASA as well. So CASA ratio remains around 22%. There'll be more details in the next slide for the CASA improvement. So total assets, 30 billion growth. Loan growth is about 25 billion, and deposit growth is about 35 billion. This is more about the loans and advances, the composition between corporate, retail, and SME, and also project finance. So composition, the retail and SME now have moved to around 39%, and that's an area where we would be focusing more in gradually increasing this retail and SME focus to make use of our presence, 106 branches throughout the island, to make use of that. So that's one area that strategically we are focusing on. Other one is on the LKR to foreign currency mix, where right now it's 76 to 24%, which we are targeting to improve into more LKR lending. So 85 to 15% kind of mix that we are looking at in the next 3 to 4 years. But all in all, 5-year cumulative growth rate is about 20% in loans and advances over the last 5 years, which are maintaining the same trend. In fact, this year it's slightly above that rate. Asset quality. You would see that the portfolio is very well diversified into all sectors. Manufacturing area, that's 22%, that's the largest exposure, but it's quite a well spread pie chart. And then the NPL ratio, you would see 22, it has improved to 2.2% from 2.63% in December. And I don't think there are any major stresses in the portfolio. We are quite happy with the portfolio quality, and whatever the individual impairments that have gone up are mainly due to some specific accounts that we have looked at. So overall, I think asset quality, we are quite comfortable with the asset quality. Customer deposits, that's where we had substantial growth. Year to date, 17% growth. If you annualize, it's roughly 34% growth, whereas last 5-year average is about 20%. So this growth coming from both LKR and foreign currency deposits, and also from CASA as well. So we did introduce 2 new CASA products during latter part of first half, the investment planner and also earlier the women's savings product. We see quite a good progress on those 2 products as well. All in all, the CASA growth alone, in terms of absolute numbers for the 6 months, is about 6 billion growth in CASA in the 6 months. And that's an area we would continue to focus on, improving our low-cost deposit base. So all in all, to improve our NIM. In terms of capital adequacy, we are well above the regulatory requirements, and also we are compliant with the new Basel III regulations, which came into effect from 1st of July. So Pillar 1, as per those requirements, Pillar 1, Tier 1 is 7.25 and total capital ratio of 11.25. We are at the moment at 9.4 and 12.8%. So we are quite well above the minimum requirements. And we are naturally working on our capital planning exercise with our growth plans. So that would continue, and as and when it seems fit to contribute capital, we would ensure that the capital would be brought in. Right now, what we are working on is improving the ROE numbers. Investor ratios. Now, the share price, unfortunately, it has come down, which reflects the market conditions as well. It's currently trading around 144, right? The earnings per share, that has improved from 19.1 to 22.8 rupees. ROE, 100 basis point increase from 13.3 to 14.6, actually more than 100 basis point increase. ROA, again, from 0.99 to 1.1%, ROE improved. Book value of the share, that's about 10 rupee increase from 149 rupees to 159. And price to book value, it's around 0.9%. Sorry, 90%. So that's where I think one has to really work on. I mean, that's actually the market perception. The book value, currently it's traded at 144 against a book value of 159, 144.2 against a book value of 159. So that's basically summarize our presentation, and now it's time for questions. So you can post your question, and we would read that question and come up with the clarification as and when you post your question. The sector that attracted more provisions during the second quarter. Other income. A lot of questions. We have to select. You all can see the question. Provisions. Right, so we have several questions. So actually, I had to go by the order. So one question is, what portion of your lending book is on floating rates and what portion on fixed rate? Niran, you want to clarify? Niran from the Treasury would clarify on that.
I would say the substantial and significant amount is in floating rates currently. And it's a very significant part is on the fixed rate component. That is mainly on the retail side. So the larger portion of the balance sheet is more in the variable rate.
There's a question on, do you see any further scope for repricing the current loan book, or will it, not as per that question, or will any future NIM gains come from new loans? I would say that definitely, yeah, I mean, pricing structure we have revised. So Definitely there's still scope for improvement in terms of our NIM pricing. Plus, naturally, the growth that we are expecting also, since most of the growth coming from the retail and SME, there again, the margins will be higher. So I think the answer to both questions are yes, there's still scope for improvement in our existing book, plus the new loans that we are booking would come at a higher price. What was sorry, all these questions are moving, so. What is the strategy to grow the SME portfolio from current size, and what is the target composition of the loan book? Okay, as I mentioned earlier, we have 106 branches, and of that, more than 55 branches have been added in the last 5 years. And that's where we see significant opportunity in growing our SME portfolio. And we being origins are development banking, so naturally the credit skills level of our branch managers, the regional network is quite high. So we need to capitalize on that inbuilt talent. So we will continue to focus on making use of our presence and also our own talent in assessing credit. So naturally, most of the credit would come from the regional network in terms of SME, plus a focused approach on the retail side. We have a good sales team, and I think the largest personal loan portfolio in the market. So we would continue to make use of those strengths to grow our retail book as well. Okay, there's a question on how much of the deposit book is maturing under 12 months. Niran?
I'd say as a percentage wise, it's basically about 75% of our deposit portfolio is skewed to less than 1 year, which is a fairly large portion of the portfolio. But that is mainly, I think it's more or less aligned with the industry. But the thing is that if our savings accounts, savings balances grow as per the budgeted numbers, and then that's the strategy, that's the way forward, then of course the duration of our liability portfolio will go beyond one year.
Okay. There's a question, I think there's a couple of questions on a similar one, so I thought I should answer that. What explained the big drop in NPL ratio? So I think 2 reasons. One is naturally the denominator, the growth in advances, 25 billion growth in advances. So the denominator goes up, the ratio naturally would come down. But on the quantum side, there's substantial improvement in terms of, one is the recovery side, and other one is long overdue, actually long recognized NPLs that have been fully provided, actually they were recognized as NPLs about 8 years back, fully impaired, were actually taken out from the book. So overall, one is the recoveries, one is some of the old NPLs taken out from the book, plus the growth in advances. So it's a combination of all three have contributed to a lower NPL ratio compared to December numbers. And there's another question, related question, what are the NPLs with respect to SME and NPLs with respect to retail? Okay, I would say that they are, sorry? The sector is wide, and then the risks are very well spread. And we don't see, in fact, the retail side, the NPL numbers are much lower than our overall 2.2%. Same with SME. And I would say that all in line with the average NPL rate. It's quite well spread among all sectors. There are no particular stretch sector as such in the portfolio. There are 2 questions about the digital banking side, to what extent would you use the digital products to grow the business? And I think that's a similar question. I think that's one area that we are focusing on. When we did our assessment, we realized that about 60% of our transactions are through digital channels. But what we had to do is to focus and have more focus on that approach. So that's where in our strategic plan also we'll be having a very key area in looking at digital channels. Of course, the mobile app, as I mentioned, is one of the great way to reach the customers. And we, as I mentioned, more than 2 billion transactions transacted through the mobile app. I would say that one of the best mobile app available in the country. And we would like that, continue to focus on more digital base. We are part of SEFT transaction, the common ATM switch. So many things that we can work on using the technology. So that's one area we are focusing heavily in terms of improving further on the digital channels. There's a question about the split between retail and SME. Last quarter was 50-50 off the top of my head. Has this changed materially? Answer is no, it's still around 50-50, both retail and SME. Because these are two areas we would continue to grow. Sanjay, you want to add anything here?
Yeah, I think both sides we are aggressively focusing on. So I think at the moment it's more or less 50-50. With both support, I think we will make sure that we achieve our targets. Yes.
There's a question on what is the bank's exposure to property development, and also what is the exposure to mortgage/home loan segment. Property sector, Bonita?
On the property sector, we are very selective depending on the location, the promoter, and the saleability of it, the price of it. And we have been progressing on a very selective basis, and we have not been going on all what has been coming.
And even the home loan exposure, I would say it's not substantial. It's part of our retail business. So it's even less than 10% of the overall lending book. So home loan sector also, the NPLs are quite very much under control, and it's less than 10% of the overall lending book. Do you have any plans to expand your branch network? If so, how much would be? A lot of questions about capex per branch and all. Employee per branch. I think general number. The number of employees we have a model based on the location and based on the potential to have a minimum number of staff to ensure that the staff service levels are maintained. So we basically deploy staff based on that model, and as and when the transactions increase, and also the volume of that particular branch increase and the branch upgrades to a different level, naturally the number of staff would be more number of staff would be allocated. So that's the model that we are working on. In terms of branch growth, yes, we have plans to grow physically, and naturally we need to get the regulatory approval as well on that. But apart from the branch growth, we are also looking at other channels. The channel that earlier questioned was the digital channel. So we would really focus on that as well as another way to reach our customers. There's a question on, have you already met leverage ratio and liquidity coverage ratio under Basel III guidelines? So in the
we are well above the minimum requirements for LCR, which is 80%. We are actually above 150% currently. And even on the leverage ratio, we are supposed to maintain a maximum of 5%. We are well below the ratio. So we are monitoring it comprehensively.
There's a question on KPIs of your new 2020 strategy device with IFC. Okay, I think I take this opportunity to very broadly discuss about that. We actually looked at our position last year and then compared to the market, and having reviewed our book, also our transactions for the last 3 months, we realized there are a lot of areas where we can further improve on. So based on that, we have worked on a strategic plan where right now we are working on more than 10 streams. And some of those streams, there are dedicated project champions, and through a very centered approach, we monitor the progress. All in all, by 2020, what we're looking at is substantial growth in asset base, and naturally to be a systemically important bank by 2020. And then in terms of balance sheet mix, I would say more, which I shared earlier, more LKR exposure compared to foreign currency exposure. Naturally, that would happen when our focus is more on the retail and SME space. In terms of ROE, naturally we have high numbers to come to the industry average level or above. So naturally it's more than 18% ROE. And in terms of NIM, to have a more actually better NIM and also NIM to fee income, better contribution coming from fee income. So all in all, I think we have addressed all key areas that we need to work on, and now that strategic plan is now in force, which we have shared with the staff, and there are a lot more development that is taking place in the next 6 months, and the real benefits of these new strategic initiatives we would see from next year onwards. There's a question about how much did the two new products contribute to CASA growth in the months that they were available. I would say that the first 6 months, I think both these products came in the latter part of actually June. One product was introduced in mid of late June, and the other product actually in this month. So it's very early to talk about the contribution to the CASA numbers from these two products, but the current numbers that we are seeing getting from the branches, our branches are quite actively working on those products. And what exactly happened was that branches also have some products to now reach the clients, and that was a vacuum that we filled through these key products that were their requirement for a long time. There's one on other than textiles, what is included in the manufacturing sector NPLs? Any material sectors?
Plantation.
In the NPLs. That's apparently
other than textile, it was plantation sector, and which has been very much controlled and monitored.
What are the foreign currency loans mainly constituted of? Import-export loans or any other sector? I would say it's
about 80% is 85% is import export.
85%. And there's a question: how does the bank intend to grow its pawnbroking portfolio in second half? Naturally, I would say it has to be a cautious growth. So that's part of the product that we have, and branches are quite equipped with that product. So we would look at growing that sector cautiously, not a significant portfolio, but we would, because that's some of the branches, staff, and also the customers do require that kind of product. So where the particular area where that is applicable, we would selectively look at those areas and continue to grow selectively in that sector. Other income, what are the key contributors to other income? Yeah, there's a question on what are the key contributors to the other income, other operating income. I would say,
apart from our normal fee and trading income and the forex income, we also had group dividends. So if you eliminate those, there is still a 12% growth from our core banking operations on fee related income.
there's a question in terms of loan growth. Which sector do you think will benefit? Has there been an impact to leasing from the loan to value ratio reduced for motor vehicles and trishaws? I think, naturally trishaws are not in a loan book. So we would actually look at the middle income category, and we had not seen a big impact due to loan to value ratio changes, and our leasing portfolio is quite healthy, and also it would continue to grow. We are not seeing that much of an effect due to that. There's a question on impairments. Although the impairments decline on half-year basis during the quarters, it saw an increase by 32% to 440 million from 333 million. What was the reason for quarterly impairment growth? Right. I think couple of reasons. One is that we looked at more granular level specific impairments, especially because I think that's right. As we move forward in focusing on retail and SME space, we need to look at the granular level, the specific impairment. So we brought the threshold levels down to more lower levels so that we can actually consider larger sector of accounts under specific impairment, and that was the reason that the specific impairments were relatively high. But on the other hand, the collective impairment, naturally with the growth in the advances, 25 billion growth in advances, when you apply the model, there is naturally a growth. With the growth in advances, the impairment numbers are also growing. So that's the other reason for the growth in the second quarter, the impairments. That's sensitive information. Please don't come later. Some of the question I missed. Out of question. Sorry, I'm going through the question because there are some questions that there are a lot of questions, by the way. I'm quite encouraged with the enthusiasm from the investors and also analysts. I'm just going through to see whether we have missed any particular question. For floating and fixed, that we share that, yeah. Now, tax rates have been above 50% in last 2 years. Why does NDB have higher effective tax rate than peer banks? Surendra, do you want to clarify? I thought we are lower, right?
Yeah. What is reported, as per the reported numbers, our effective tax rate is 39% for the 6 months. Of course, there is group dividends, which is exempt from income tax. So if you remove that, it was a 52% growth and 52% effective tax rate, which with FS, VAT, income tax altogether, it's as per the industry, it's about 55% effective tax rate. So I think we are on par with the industry.
There's a question on what is your view on interest rates? Niran, you want to take that?
I think these interest rates, I think probably we have seen a decline in the government bills and bond yields. There's quite a lot of liquidity in the market. So the perception has been created that the interest rates tend to either stabilize or come down a little bit in the next 2 quarters. So that's the bank's view also. So based on that, we are taking certain repricing decisions in the balance sheet, which will see that our NIMs and all that to improve. So basically, the answer is that we expect the rates to decline a little bit from the present levels going for the next 6 months.
And there's another one on LKR, expectations on LKR depreciation, Niran.
Yeah, I think it's been very clearly communicated by the central bank and also by the governor that it will be the exchange rate will be determined by the market forces, demand and supply, and they will not intervene, especially by selling the exchange. So that we expect currently the currency has depreciated by about 2.5 to 2.2%. So I think the same trend will continue, and also we have seen a lot of inflows coming in. Even during the last couple of weeks, certain inflows have come into the bond market, and then also the certain other remittances and also some of the infrastructure for development purposes. Some of the larger funds are expected to be here. So we feel that the market will not be much volatile, and should be a gradual revaluation, maybe with about another 2 to 2.5% room is there.
There's a question on no plans. Are there any plans for a capital issuance this year? And the second question is, has the mix between working capital loans and capital expenditure type loans varied materially over the last year? With regard to capital issuance, we would actually closely watch the growth in advances book and then take a decision. Right now, we are quite above the Basel III requirements. So in terms of numbers, we should be able to manage. But however, if the growth continues and if we see, especially if early next year, the growth level, we would definitely look at a capital infusion. One has to balance the optimum level of capital and also the growth. So we would, that's an area we would continue to focus on. In terms of mix between working capital loans and fixed loans, there's no major variance compared to last year. I mean, I have not seen any major variance in terms of working capital versus the fixed loans. What was the source of loan? What are the source of loan growth in terms of new customers versus existing customers? I think it has come from both areas. That we have quite a good set of clients, I mean, naturally with the NPL level below industry average, if there's opportunity to grow those clients, those clients also have plans to expand. Naturally, that's where our first preference to support our existing clients. And then, with the branches, new opening of branches and all, there are opportunities for us to look at new clients. So it's actually coming from both sides.